Great. And Paul, I think we have a few more people coming in, but I think it would be great to get started. So I just want to say a great big thank you to everyone who is here today. And we're going to be talking a little bit about the markets. I am Stacy Francis, and my colleague here, Paul Stages. We are your guides to one of the most rocky up and down times we have seen in modern political history. And I don't know if you feel this way, but this morning I needed a double espresso, and tonight I know I'm going to need a glass of wine. How about you, Paul? How are you doing?
Yeah, I would say it's been the 2020 of weeks, and so lots to digest. And so our goal for today is, we understand that every day it's all sorts of different news coming out, and we want to put things into perspective of what to be paying attention to, what not to pay attention to, and how to position yourself for long-term financial success. So, Stacy, you said it. This first slide that we're going to start off with, it's changing minute to minute. The presidency is far from being decided. So as of now, it is unknown, although it is looking most likely that former Vice President Joe Biden will be the next president starting in 2021.
Yeah,
And
and
so we've
Paul,
all,
I actually have a couple things off the press that I just got, so I wanted to share a little bit where we are, because you're right. It's looking a little bit more why things are unknown. It's looking a little bit more like Biden is going to be.
mhm,
So he has a slim margin now in Georgia.
yep,
He also has a margin, almost 50,000 votes there in Arizona,
yep,
expecting that that's going to go to him. Nevada, he also has a lead. Now Trump is still in the lead with North Carolina and Pennsylvania. This is where all the eyes of
mhm,
the country are looking at. As of 8 o'clock this morning, Biden had actually taken the lead with a little over 18,000 votes. And I just checked before we went live here, that's up to 23,636 votes ahead of Trump. So wow, I feel like this is the most exciting, stressful, anxiety provoking presidential election that that I remember.
yeah, and it's no surprise that the markets have had their ups and downs. Um, Down week last week, very strong rebound this week because we did start to get a little bit more clarification. And so, although again, nothing has been decided, not even in Congress or who is going to be the next president, it is investors have started to assume that it's most likely going to be Biden as president. The Senate will stay in Republican control, and the House is going to have a Democratic majority. So it's going to be what's called a split Congress. And so investors are trying to digest, okay, what does that mean for real life implications? What does that mean for any stimulus bill that might get passed to address the ongoing COVID issue? What does it mean for industry regulations? What does it mean for Biden's tax proposals? And so that's why we are seeing some of these whipsaw effects. Um, this week, though, we've seen a net positive for the markets. Investors are thinking that with a split Congress, it could be that we don't see sweeping large scale changes to the tax rates that we saw from a few years ago that were more favorable for corporations. Certain folks received a tax break. So the thought is, well, we might not see increases in taxes. So that's a good thing for the markets, at least in the short term. What we might also not see is that large of a COVID stimulus bill, which is seen as a bit of a negative for the market. So you weigh the positives with the negatives, but overall, what we've seen is a positive response by investors, at least this week. Um, you know, Obviously, we're not out of the woods yet. Trump and his administration are looking to potentially put up a fight with challenging some of these electoral college decisions. And so if this does continue to drag out for weeks or potentially months, um, it could look something like in 2000 when there was Bush and Al Gore, and that was not so great news for the markets. The S&P dropped about 5% in that time frame. Um, that was unexpected this time around. It might be a bit more expected, but that remains to be seen. And then, of course, there's COVID, which is looming large over the economy, and we'll see also what um, the government's response is to that. This shows that this week we have seen some rebounds from last week's uh, brief market downturn. And then here, the market does hate uncertainty. So kind of the flip side of that is they love certainty, and they equate certainty with the divided government, where if the Senate does stay Republican and the House of Representatives stays Democratic, that again there might not be sweeping tax changes, might not be a Green New Deal and some other things that are seen as potentially headwinds to businesses and to the markets. Um, and if we continue with that theory, this is some numbers that Jeffrey's research put out this week, where if we look at the last 30 years, when there's been a Democratic president, so essentially 2 terms of Bill Clinton, 2 terms of Barack Obama, there were some terms where there was a split, where not both houses in Congress were Democratic, but there were some instances where that was the case. And in the cases where there was a split government, the S&P 500 actually outperformed the terms where the entire government was Democratic. Granted, this isn't completely large sample size, and we know that stock market performance, the economy, is more than just who is president at the time.
And that's good. What's interesting about the market is that the market actually, if you think about them as a person, they're the least political person you would ever meet, especially in these times, because the market doesn't really care about if it's a Republican or a Democratic president. And what we have seen over time is that the different presidential terms that you see here, and we actually put this together. We went back to all the way back to Hoover, 1929. I'm not sure if anyone was alive on this call during Hoover, but if you look at all of these different time periods, you'll see, of course, certain time periods where on the your left-hand side of the screen, you saw losses. But that's not surprising. The time periods you see the Great Depression right there in the 20s. And then you also see under Bush with 2008, so the ending of 2008. But if you look at all of the other time periods to the right of the chart, they're positive. And it's hard to draw an exact correlation between who does better, a Democrat or a Republican. On the next slide, you'll see what we did is we actually looked at, and I love this because this was hard too, especially with the one-termers to get those pictures in. But what's interesting, this is the S&P 500 over time. And we went again all the way back to 1929. And what is, I hope for all of you, a very comforting piece of data is that what do we see as that trend line? That trend line is a steady march upwards in growth of the S&P 500. And yes, you can definitely see some volatility, some steeps and some troughs, but that ongoing long-term road is one that is upwards. So who does really outperform, whether it's a Republican president or a Democrat? It's interesting. the data shows very little margin of difference. Democrats just mildly outperforming a little bit if you go back and look at all the different terms, but nothing that truly is of significance. And on the next slide, you'll see why. Because the investment outlook that we have, it truly is less about who is in the Oval Office. And it's much more about what's going on in the economy. So we have some things happening, hopefully a stimulus package. And when I say hopefully a stimulus package, I'm less concerned about the market. I'm more concerned about the thousands, the hundreds of thousands, the millions of individuals who are financially in very dangerous situations. We also, though, are seeing that the economy, despite the coronavirus, that it's still hanging in there. And we're actually ahead of where we thought we would actually be versus when things started to break back in March and April. But the long-term fundamentals of where we're going to be, whether it's a Republican president, a Democratic president, whether it's a divided government or it's not a divided government, the more important fundamentals are the economy, looking at economic growth, looking at productivity, looking at job and unemployment claims, and looking at interest rates. Those are the pieces that have a much bigger impact on the party that is in power.
Yeah, no, that's well said, Stacy. And there are so many things at play, like what you talked about, the job market, interest rates, trade between nations. These are things, though, that you and me, everyone else on the call today, that's out of our controls. So what we want to talk about, though, is what really is in your control. And so we see it as, the good news being it's relatively easy to build a pathway, to have a strong financial foundation, to have a strong investment plan that works not just in the short term when there usually is ups and downs, but also for long term, to take advantage of what we just went through, to see that the markets do really go up over time, and they really do reward long-term disciplined investors. So the first thing to keep in mind is just let the markets work for you. I love the phrase of it's time in the market. It's not about timing the market. So it's not about, is it a good time to go into the market? Because if you're going to think about all the different factors, you can always make an argument to not invest. It does take a bit of a leap of faith, but you'll see over time that you are rewarded for that, as long as you have a good plan in place, as long as you do all of these other things that we'll talk about next, which is to make sure you're investing in a tax efficient manner, so that if taxes do go up, that you have a plan in place to protect some of the income that's thrown off by your investments, or if you want to sell for gains, that you're doing so in the most tax advantageous manner for you. So we're not saying tax evasion.
Yeah.
We're advocating for just being smart, tax savvy investors, so that you keep as much dollars in your pocket and not pay unnecessary taxes. And an easy way to do that is to contribute to employer 401ks, for instance, where you can continue to defer income on that growth for many decades.
I was reading a really interesting study that I thought was fascinating, that tax efficient investing, it doesn't increase your risk. It's just being smart about using 401ks, using retirement plans to their maximum, but then also making sure that something that might be an investment like bonds, that when it throws off a dollar in interest, you pay it as if it comes to you in your paycheck, that highest ordinary
Mm-hmm.
tax bracket. Being smart about where it goes, and that over time it adds a return of 1 to 2% on top of your return, just by being efficient. And that wow, with no risk and more return, and just by being smarter, is really clear. And can you talk a little bit about how we do that for our clients? Because I feel like in particular, this is not the most straightforward.
Sure. Yeah. And the idea is that you start off with a bird's eye view of how you want your investments to look. You're going to tie them to your long-term, intermediate, short-term goals. And then you take a deeper dive into what accounts do I have? And you're not going to necessarily invest your 401k the exact same way that you are going to invest your Roth IRA, or that you are going to invest your non-retirement, call it your brokerage account. Your 401k, because that is an account where you can defer payment of taxes on your income, that's where you'll want to put in income producing investments. And so that's what we do for our clients, is we'll recommend dividend paying stock funds in there. That's where we'll recommend that they hold bonds that pay periodic interest payments. So that's a very savvy way to grow your money in that account. And then
You're
things
essentially protecting it, not having to pay taxes.
Exactly. And then a Roth account, which we know you pay taxes up front, but then it's tax free the rest of your life. That's where you can put some of these assets that you think are really going to balloon. So that's where it might be tech stocks or emerging markets stocks in there. So the idea is that overall, you want to have each of these accounts be in sync, but not to have each and every one of them look exactly the same, because then you're really missing out on the tax efficiency. Um, and in that similar vein, another way that you can easily reduce or increase return without increasing any risk is to choose low cost investment options. So this is something where, again, studies have shown that you can easily increase your return up to a percentage point, if not more, by just being very prudent in which types of mutual funds or ETFs, which are a phenomenally efficient way to own large swaths of the US stock market, of the non-US stock market bonds.
Yeah.
Um, to do that relatively cheaply. I've said this many times that it's an amazing time to be an investor, because you can hold literally thousands of company stocks
Yeah.
and do it for almost no cost.
And I think this is so important. And I think about like the amount of time I just spent. So Michael's birthday, my husband's birthday, is tomorrow. And I'm getting him, no one share it, but I'm getting him an Instapot, because we've been doing a lot of cooking at home. But you should have seen me price shopping, comparing, and the amount of effort that went into that. And unfortunately, the average investor is not doing that with their investments, their financial future, and potentially spending thousands of dollars more than they should for an investment that's even possibly lower quality than a lower cost
Hmm.
investment. So I totally agree with that one.
Yeah, no, and there are a lot of options out there, and it could be overwhelming. Um, and but again, the good news is that there are options that um, you can put together a very well diversified portfolio out there, because this chart is overwhelming in itself, and that's kind of the idea, is that if each of these little squares represents a different major asset class. And what you'll find, if your eye just catches onto, we can just track what small company US stocks have done over the last decade. It's interesting to see that it basically does become a bit of a roller coaster ride. In 2010, you would have been feeling great having small company stocks in 2011, not so much, and then a rebound in 2012, 13, and you can see it ebbs and flows, ebbs and flows. Um, and that's why we never recommend to anyone that you just own any one piece of the market. Even the S&P 500 has done very well over the last 10 years, but if we stretch it out over time, it too has some rough patches. And so that's why together, though, you can put together um, a very nice, well-diversified portfolio where all of a sudden it's represented by this green where you don't see as much of that up and down. You don't feel that roller coaster effect where honestly it becomes very difficult um, to jump in and to invest if you're only going to be invested in one part of the market.
Yeah, it's interesting, Paul. So if you look at emerging markets in 2011, the worst performing asset class, if you decided that
Mm-hmm.
you had it and decided, I'm getting out of emerging markets, the next year, 2012, it's the highest performing asset class of all of them. You would have missed that. So, what you're saying is so key, and I would say one of the most important messages of today, that it's time in the market, it's not timing the market. And people who try to play this game, the people who are market timers, we see that their investment performance is actually 3 to 4% lower than the average investor, who just, again, picks that ideal allocation. We make tweaks along the way, but is not trying to day trade and read the tea leaves, because anyone who tells you they know what's going to happen in the market, they're lying. They're
Yeah.
lying, because we all don't. I mean, we have ideas and there are things we can do, but from a day-to-day basis, that's a fool's game. It's a fool's game.
Yeah. Yeah. And what's great though is that an easy solution is to really have that own many of these at the same time so that yes, you're limiting that upside win, so to speak, but you're also protecting yourself on the downside, and it gives you more peace of mind. And studies have shown that it is a much more effective way to meet your long-term goals as an investor. And this chart shows again of why it is important to be disciplined, to stay invested even during the down times, because over the last 100 years or so, we've seen that there have been 15 bear markets. So when the stock market goes down 10, 20 plus percentage points, just as what we saw back in February and March of this year. And then there have been 15 bull markets where the stock market is humming along and growing at a great clip. And so you'd think, okay, if there are 15 bear markets, 15 bull markets, then it's a zero-sum game and it's a 50-50 coin flip, and maybe I should just stay out of it and keep my money under my mattress. But the good news is that these bear markets, even though they feel terrifying at the time, just back in February and March, if you were just invested in the S&P 500, it would have been a scary time, feeling like there's no end in sight. Although we saw the fastest recovery in history. Um, and so what's great though is that even though it's an even amount of both bear and bull markets, the average bear market lasts in the order of 5 to 10 months, where the average bull market lasts 5 to 10 years. And
Wow.
so you really, it's much easier said than done, but you have to kind of power through those choppier waters to get to that calm and to be able to reap the rewards of, for instance, 2010 to
Yeah.
2020, where we saw a very long, very prosperous bull market for investors.
Yeah, I think it's interesting because you see how short those bear markets are. And
Mm-hmm.
I was reading, you know, essentially just remembering 3 out of 4 years is going to be a positive market. You're going to get a positive return in the market. And yes, on average, 25% of, is going to be negative, but if you don't stay invested, you're missing out on the 75%.
right? And on a day-to-day basis, it's closer to 50%. And that's what scares people.
Yeah.
And as humans, we feel that loss twice as much as we feel the gains. So
I feel the same way, though separately. I'm much more upset when I gain weight, and so unfortunately I have the reverse. And I don't know if there's any other COVID weight gainers out there. I hope I'm not the only one, but how upset I've been with like the things I've gained. And then I've actually lost, a good amount of it, but I'm still frustrated. So I think it's a inverse relationship with weight. I'm just
there we go.
not for a man, maybe not for a man, but I'm just saying for a woman.
We'll have economists study you, Stacy.
We will. I'm sure there's some behavioral finance explanation for that.
And then to continue to kind of drive the point home, but it's looking at the data of yes, we're facing yet another worldwide crisis. They're one of many that have happened over the course of history and over the last 50 years. And while that might mean some short-term downturns in the market, what we've seen is overall it does track up. The market does reward those disciplined investors, especially those who have diversification, are owning large swaths of the market. And so this chart shows that if you invested just $1 in the global stock market 50 years ago, you would have had returns 70 times that by today. And that's with all of these different, what ended up being temporary crises of each of these times.
Yeah, I have to say, just seeing this chart, I remember many of these things, how anxiety provoking. I mean, living through that. But then again, you see the market just continuing to march upwards, which I think is really wonderful. Really, really peace of mind, bring some peace of mind.
Yeah. And so I believe we may have had some questions. So let me.
Great.
Okay, we have a question here. How much would the relationship between the president and foreign countries affect the market? President Trump did not have much of a foreign presence, especially after COVID.
Yeah, so this does impact it. A lot of the conversation that is being had is talking specifically about the relationship with China, and some feel that Biden's policies will be still very strict, but looser when it comes to tariffs and some of the other political sanctions that have been talked about and put in place. So it does have an impact. Something for you wine drinkers, just again, kind of bringing this all into the international world and how sanctions and our international policies can impact our economy and can impact also the market. If you go to have a bottle of red wine, there's now a 30% tax on it that was imposed over the last couple of years as part of the Trump administration. And it's not that Trump doesn't love red wine, because I'm sure he does, but that was to try to protect and give California vineyards a standing chance to be more competitive financially. But what ended up happening is that we see consumers being the ones that are unfortunately having to pay those higher prices. So yes, very much what is going on in the President Oval Office and their policy internationally does impact us very much more now than it has in modern history. When I grew up, the United States was quite insulated. We didn't depend on foreign trade nearly in the same manner. And now the world is truly a melting pot. And so seeing what actually gets passed and what those policies look like will be really key and important as we go forward. And it's one of the main things that we work with our outside research partners to stay on top of, to make sure that you're protected and that you're in a diversified portfolio that can weather the ups and downs of whatever policies are put in place, whatever tariffs are put in place, and whatever situations can arise from our economic policies. It's a good question.
I believe that is the only question we have. So
Yeah.
I guess we solved all the problems and answered everyone's questions,
I don't know
Stacy.
about that, but I mean, you know, the next thing I want to talk to you guys about is a really nice event that we have on socially conscious investing that's coming up December 3rd. There's no charge, and you can just email myself or Paul, Stacy at Francis Financial, or Paul at Francis Financial. And also you can see client relations at Francis Financial. Please come and bring a guest. Socially conscious or ESG investing is something that is very close to our heart, and it is a wonderful way to have your money grow and support your financial future, but keeping your values also in mind. And so we're going to talk as part of this money circle, a thoughtful discussion about what socially conscious investing really means. And we'll talk about how you can walk away with action steps to not only make better choices in what we do in life, but the choices you have in your investment portfolio. And something that is really important to know is that we have seen that socially conscious investments overall have outperformed their non-socially conscious counterparts. And so I know that makes me feel really well too. So, but I want to say thank you. And I also just want to end this on a up note of all the data is showing that the highest number of Americans turned out to vote in this election. And it's the highest number they've seen in modern history. And I think so much of what we're having to do as far as the patience that we all have to have as the ballots are continuing to be counted and the news continues to pour in and change, that patience that we have to have so that every single vote is counted and every person who casts their vote is honored. I feel like that patience that we're having to have is also the same patience that we have to have with the stock market. And the more patience we have, the more that we're going to make better decisions about our money, of knowing that it's going to go up, it's going to go down, but having patience of investing for the long term. Long-term investors are the ones who get ahead. And that's what we hope today's conversation has really highlighted for you. But most importantly, if we can support you in any way, and if you have any loved ones or people that you care about that you're concerned about, or they have questions, please reach out. And we are here for you. And we work with couples, we work with individuals, but our specialty is working with women, and women who are dealing with a transition, such as a divorce, which is unbelievably frightening, the loss of a spouse, which is heartbreaking, or an inheritance or some other type of change. All of these things can be overwhelming and frightening, and all of those things combined. So if we can help anyone, please let us know, because that's what we love to do. And that's why we love our work so much. So thank you so much for joining. Paul, thank you for doing this. Was a great way to start a Friday. And this was a lot of fun. I'm hoping everybody else had as much fun as we did. So thank you again, and we will record this and send this out. So if someone missed it, we can make sure that you get a copy of the recording. We tried to keep it short and sweet with lots of powerful information. And have a great Friday. Keep your patience, and most importantly, know that we are here for you. Thanks.
Take care, everyone.